This is Andrew Stotz of Stotz Investment Research, and today I'm in China at my university where I'll be teaching some classes on valuation. But before I go into class, I want to talk about cash at consumer staple companies in Asia. So consumer staples, well, here's one right here, coffee, which I brought from my factory in Bangkok, having a nice cup of coffee. Now, what I'm showing here is a collection of constituent stocks of MSCI to help us understand how markets break down in Asia. We have four categories that I put markets in. One is developed Asia, another is emerging Asia, 80%, another is emerging Asia, 20%, and then there's frontier. The difference between the 80 and the 20 is just the number of shares that are available in those markets. China, Korea, Taiwan, and India all have a large number of shares compared to Thailand, Malaysia, Indonesia, Philippines, and Pakistan. What I mean by that is shares that are large and liquid. Now, I have done my own research across all of Asia by looking at all stocks that are available and basically accumulating those for each country. And so it's a bottom-up aggregate, and this gives us an idea of the consumer staples companies in Asia and their levels of cash over the last 3 years. What we can see is developed Asia average is about 11.7. Emerging Asia 80% is about 14.5. And emerging Asia 20% is about 9. So some of those countries such as Thailand, Indonesia, and Pakistan have a low level compared to others. And then you have frontier Asia average, which is about 12.9%. So we can see that there's more cash actually at the frontiers companies than at the developed countries. And one that particularly stands out is Vietnam at 19.4. Now, because let's go back one step and go back and look at our table on Vietnam. There's 34 companies that MSCI considers constituent stocks for their index. Now, in my work, I go down a little bit lower than that, so I may have 40 or 50 stocks in that, but it's a small number of stocks. But still, what we can see is that they have 19.4% in cash as a percent of assets. Now, last thing I would mention before we go on to the charts is that why is this important? Well, if you're an analyst forecasting, one of the biggest mistakes that analysts make is that they accumulate too much cash in balance sheets. When we're trying to do free cash flow valuation, cash in the balance sheet is a very important factor. So let's take a look. First of all, if we look at the developed Asia countries, we can see that as we've been seeing in this data across sectors, Australia and New Zealand operate with the lowest level of cash. Hong Kong has the highest. The next one that we can see is if we look at emerging 80, we can see that China and Taiwan keep the most cash, and India has doubled its cash levels over the years. That particularly jumped in 2010, where companies went from about 8% to about 12% cash as a percent of assets. So a big improvement there in India. Cash levels is falling in most of the emerging 20 countries. The highest levels are at Philippines and Malaysian consumer staples companies. And finally, here is the frontier markets where we highlighted earlier that Vietnam has a very high level of cash as a percent of assets at the consumer staples companies. So again, we can sum this up by saying that accumulating a lot of cash in the balance sheet is a common mistake, number one mistake that I see analysts do when they're forecasting. This will give you a guide to not accumulate more than this amount unless a company has a specific case. Of course, these are averages, so some companies may consistently be above or consistently be below. Of course, we're also not considering the whole issue of how much cash should a company have. What amount is maintenance cash or cash that needs to be done for operations, and how much is excess cash. So we can talk about that at another time. Anyways, have a great day, and I hope this helps.